Welcome to finals week on Outlier University, and let's begin. So, first question: how does journaling trade? Now, this is going to Paul. How does journaling trade by trade help refine entry criteria in a trading strategy? Feel free to go as long as you want, Paul.
That's a tough one. So my entry criteria are using the golden ticket strategy from Outlier. So I haven't deviated from that. I picked I use the buy signals, 10 over the 20, price over the 50. I do when I enter a trade, I do enter the details into Dave's trading journal. But you kind of have me at a loss here. I don't know that I have refined my entry criteria through my journaling.
But let's say that you were following and creating your own plan. What would you be looking for in your trading journal to come up with how to make those refinements?
So I would have to employ some back testing, look at the trades I've taken to see how my strategy has been working. Look at the things that I can change for my entry criteria, whether it be sector strength, market breadth, overall S&P strength, where the stock sits in relation to the exponential moving averages.
Okay, so if you were looking at different exponential moving averages, what would you want to see, right? If you're back testing, if you're coming up with new ideas, what are you looking for?
Well, I'd want to make sure that I was following the trend, because we are trend traders. And the trend that we look for is 10 over the 20, price over the 50. Some of the other things that we look at are the fear and greed index. You know, is the market overbought? Is it too greedy? Are we looking at a snapback? Did I get in too late? Did I have any FOMO? And, you know, stock just was skyrocketing and against my better judgment or against the tools that I was using, I went in and jumped in just on an emotional trade.
Mm-hmm. So let's say that you were looking at, you've journaled all your trades and you've got a list of winners, a list of losers. What could we learn from one to the other?
I think you'd want to make sure that you were actually following your plan, that you didn't create losers by deviating from your plan, whether it was your entry or usually for me, it was exit points. Sometimes I would deviate, and those were some of my worst losers where I might panic and not obey my own rules.
That makes sense. So basically what we're getting at is that in order to be successful as a trader, you really do need to document the trades you take. Would you agree?
Yes.
Yeah. And if you document the trades that you take, that should allow you to see certain characteristics of winners and losers. Would you agree to that?
Right.
So the more you get used to the market, the more you get used to any trading strategy, right? It can be completely separate from something you've done before and you just want to try it out. Maybe you want to start day trading and then you start back testing. You see, okay, when I start day trading, this seems to work and this doesn't. Where do we start to make those refinements? I'm looking for one thing in particular.
Where do we make the refinements?
So basically what I'm getting at, Paul, is you have your list of winners, you have your list of losers. That's when you start comparing the two and you see, okay, if my winners have all of these things and my losers have all of these things, what are the things that are different, right? What happens to losers that doesn't happen with winners, right? And maybe it's a golden toilet treat came out and we can't control that. Maybe that happens and we can't control that, right? But maybe there's something where on the winners, it happens to be above like a 50 period moving average. And you notice that on your losers, only one of those happened to be above its 50 period moving average, and the rest didn't. And you could say, okay, you know what? Looking at this side, right? The characteristics that are the same and the characteristics that are different, I can start merging the two. And when you start making those revelations, reviewing those trades historically, that's when you can start really refining a plan. And you can come up with any strategy and just really start targeting in and find where those little nuances are and create something incredibly profitable. So I know I put you on the spot there, Paul, but you did great. You did great.
Well, I don't have as much experience as some of these other guys, so I've been doing it.
But you're about to have an LRU diploma, though. You're about to have a shingle to hang on your wall. What's up, Joe?
So before I found you in the Outlier community, Chris, I was trying to figure out where I belonged in trading in general, right? Because there's so many different styles of trading. And one of the things I was trying was futures. And I did what you have kind of helped us build upon, and that was made a plan. And I just put it in Google Sheets. And I had all these lines with all my trades and the decisions I made to get into them. And what I decided to do one day is make if statements.
Mm-hmm.
It ended up telling me if I followed my plan or didn't follow my plan. And what I found was I couldn't follow my plan. So I found out that I could not emotionally trade futures with the plan that I had, and it got me out long before I lost my portfolio. So it was fantastic.
There you go. And that's a great thing, is that you can decide if it's right for you or not right for you, right? It doesn't have to be that everybody trades the exact same markets the same way. It just doesn't. So the idea here with backtesting is to come up with data to prove that your plan works, right? It's one thing to say that it's going to work. It's another thing to try and manifest from the universe that it's going to work. But until you've taken the time, you've gone through the data, you've proven that even your worst case outcome can still be profitable. It's all just theory. It's all just theory. The difference between like most companies that put out, software and Outliers, we actually do trade with Outlier, right? A lot of companies, they come up with something, they try and sell it, and that's it. Whereas we are taking the other approach of, I want to make as much money as I humanly possibly can with Outlier. And at the same time, if I can make money with you guys and Outlier, even better, right? So that's the difference in what we're doing here, is we want to make as much money as physically, humanly possible, right? One of my trading heroes, Jerry Parker, we watched him one day. He was the guy who had the birds on his shoulders. He was one of the original turtle traders. He is quoted as saying he wants to make masters of the universe money. And I'm like, freaking yeah, that's exactly the level of wealth that I'm trying to get to. Master of the universe money and nothing less. So Paul, that's an outstanding question. I will give you an A today, but now it's Brad's turn. Let's see, Brad's getting nervous over there.
I'm finding the mute button.
As he should be, because this is finals week at Outlier University, and we're not going to take it easy. So, Brad's question. Why is price move more important than profits when analyzing a stock chart? And how does that flip traditional investing logic on its head? That's a deep one. A deep, dark one right there for you, Brad. So,
it is. Where's deep thought?
He left you high and dry.
He did.
Take a minute, analyze it, come up with what you think. Give you some good answers here.
Important than profits when analyzing a stock chart, and how does that? I mean, if we start from the end of the M dash, how does that flip traditional investing logic on its head? I mean, traditional investing logic says you buy the dip, right? And you watch the price. As the price goes down, people believe that you're actually getting stock on sale, right? And so the traditional investing says buy it as it's going down. But when we as outliers are looking at the charts, the stock charts, we want to see the price moving up, because when the price is moving up, our profits are following that. They're not following it as it's going down. They're following as it's rising.
Right.
So
Keep going.
That's, I mean, in the shallowest terms, that's what it is. It's the following the trend and watching the price of the stock and making sure that it is at the level that we need to see it at. That it's over the 10 EMA, it's over the 20 EMA, and it's actually over the 50.
Mm-hmm.
And that's the most important thing. Getting all those trends going up while we're looking at it.
Right. Let me ask you some follow-up questions here.
Please.
So if let's say, for example, that you were concerned with what color your Lamborghini was going to be, how would you treat your trading differently than somebody who actually is trying to be successful in the market, right? Let's flip it on its head. Let's do inverse thinking here.
Okay.
If you were trying to pick out the color of your Lamborghini, how would you trade versus the person who is following systems, following processes?
I don't think that there's a difference. I mean, when we follow the process, that's when we make the profits, right? So I don't think I would trade any differently, because over the last several months we've come up with the process, with how to make the plan and how to implement the plan.
Okay.
I might not be.
Let me put it in a different way.
Okay.
If you are trading based on the outcome versus trading based on the processes, do you think you trade differently?
Yeah, I'd probably trade like I did before. Just chucking money at different stocks, and listening to random people on the internet.
Right.
So, yeah, if we're going to be, when you enter a trade, there's no expectations on it. So when I enter a trade, I can't think that this is going to buy me that green Lamborghini. When I put that money down, I don't know what it's going to do. I have no expectations on it. So I'm just following my process.
There we go.
And, and hopefully, the price will go up on it,
Right.
And then the profit. So
there we go. That's what I was trying to get out of you. There we go. Right. Because for example, if let's say, Brad, let me ask you this. If you wanted to step on a bodybuilding stage, right?
Mhm.
Let's say you're getting down to your tighty whities and you've been working like Arnold, right? You're ready to do this thing.
All right.
Do you think that Brad today could just say, all right, let's do this and hop up on stage? Do you think that Brad's ready for that?
Heck no. No one's ready for that.
So
no one's ready to see me do that.
Well, there we go. So what would Brad need to do in order to make that a reality?
Just like Arnold said, pumping iron, right? I mean, I would have to focus, get in shape, follow a plan before I can get on stage with my tighty whities.
Exactly. You got to put in the work exercising. Yep. You got to put in the work in the kitchen. You got to put in the work on your cardio, right? It wouldn't happen on accident, and it wouldn't happen immediately. And because of that, you'd be focusing in on the processes, making sure you followed the processes in order to make sure that you could have the outcome that you wanted, versus focusing in on the outcome and just hoping for the best.
Right.
The outcome will happen automatically when you focus on the processes. But you can't have that outcome unless you focused on the processes first. Does this make sense?
Absolutely. Yeah.
Very cool. All right. Awesome.
Cool.
Great work. I'm going to give you an A as well, my friend. Ian?
Oh, pressure's on.
Pressure's on. The internet's working well between here and Australia, so that's good. This is a really, really good one.
Oh, thank you.
I gave it to you, Ian, because I was like, this guy, he's going to know. This guy's going to know it.
I hope so.
So the question
Is
why is relying on dividends as a primary reason to buy a stock flawed in a momentum-based strategy?
relying on dividends as a source of income, part of your income, could mean that the stock will trend down. If it's trending down and you're getting dividends, it's offsetting that loss in the value of the stock. Can you put that up again? I want to read that again.
Yes. Why is relying on dividends? Let me click the right button here. Why is relying on dividends as a primary reason to buy a stock flawed in a momentum-based strategy? Or really any strategy, in my opinion.
Yeah, exactly. Well, the reason for buying the stock is, for us, we want to make money from a rising price. And if the price is falling and you're relying on the dividend could well reduce if the price is falling. And you've got no guarantee that your dividend will go up. And if the price is falling, the value of those shares is falling. So the value of your investment is falling. And if it's trying to be offset by a dividend that may or may not be there in the future, it is a flawed strategy.
But Ian, isn't it just easy money to just buy a stock and, take that dividend income? It
is easy money, and it could be easy money. It could not be. There's no guarantee. There's no guarantee that will pay a dividend. I was watching some charts the other day, and this stock went down to 0.0007, and I'm thinking, hang on,
that was the price.
How can that be possible? That's the price. I'm glad I don't own that. That's not paying any dividends soon. And there's no guarantee that the price will go back up. There's no guarantee that you'll get your money back at all. So yeah, it's a flawed strategy because there's no guarantees. And I mean, there's no guarantees playing this game anyway. You just got to have your risk in place and not lose more than you can win, basically.
Right. But Ian, right? Hey, old Uncle Warren, he makes all the money with dividends, right? Isn't he the smartest investor ever? Why wouldn't we want to do what he's doing?
Yeah, we don't have bucket loads of money. We don't swim around in it.
Rich McDuck style, right?
Yeah.
Well, not only that, but his time horizon is probably not the same as our time horizon, would you say?
It's horses for courses. We've got to stay in our lane.
Right. Exactly. Yeah. Now, the way that I look at dividend stocks is if I happen to own the stock during the time that it pays a dividend, all the better.
It's a bonus.
That's a bonus. Exactly.
Yeah. But don't focus on that.
I'm right. I'm not going to give up. In this case, people will call it net asset value when they talk about dividend paying stocks. I'm not going to give up net asset value to earn a dividend. In fact, last one standing had a really good quote here. If you're down 10% on a dividend paying stock, it is senseless to be happy about a 4% dividend. Would you agree to that?
Exactly. Yeah. It's a negative outcome, and we don't play that game.
Right. But Ian, I mean, come on, 4% for free?
Nothing's free.
Exactly. Because all stocks are
bad, and sometimes they act right.
That's right. And even if they pay you a dividend, they're still a bad stock.
They may not act right if they pay you a dividend.
Outstanding work, Ian. You did great. I'm definitely giving you an A on part 1 in the finals. Great work, dude.
Thank you.
Mike, are you all set?
I am set.
Awesome. Okay.
All right.
Out of the truck, on the couch. You ready to do this?
It could be chaos at any moment where I'm at, just so you know.
Let's get it done quick, right?
Okay.
All right, Mike. How can a stock increase in price when a company reports bad news?
Wow. When the company reports the bad, it's not news about the company from a third party. The company is reporting bad news.
Right. Let's say Hims is a decent example, right? Hims is down 10% today, almost 11% today. Let's imagine, I didn't read the news reports or anything like that. Let's imagine that Hims is down, but their guidance is great, right? Or vice versa, Palantir. Let's imagine that Palantir is up, but their news was terrible. Okay, so you got two different possibilities here. Why and how can that possibly happen?
Oh man, the how. I don't know if I care. On the how, I don't listen to the news. I mean, I'm just looking at trends. I'm looking for the upward trend on the stock. That's not what you're asking me though. You're asking me how can that be? I don't pay attention to the news. I look at this. I look at the 10, 20 and the price over the 50, and I don't listen to all the chatter. That's why I never go in the general channel anymore. But I'm still not answering that question. I don't think. How can the stock increase price? I don't know the how. I honestly don't know the how that can be. I've just never cared about it.
Let's think about it from different terms, Mike.
Give me a hint. Yeah, give me a hint here.
So
now I'm down to a C, right?
No, you're good. You're good. You're good. Let's say you walked into the casino and you were like, I like roulette. There's no greens on this board. It's only reds or blacks. In my opinion, going up to earnings is exactly that. Because the stock can report whatever news it's going to report. And anything can happen with the price. Right? We've seen stocks report incredible news and the price gets absolutely monkey hammered. We've seen stocks report terrible earnings per share and whatever else, fundamental metrics there are, and their stock price rockets. Right?
Right.
What's causing this? Like think a little bit more big picture. Take a step back. What's causing this?
What's a safe bet would be to say it's a psychological thing where
you're on the right track.
Yeah. Somebody screamed buy or somebody screamed sell, or in fact, we took a little bit of a loss on that kind of a thing. We put as an outlier group on the last, can't remember the stock what it was, but we started seeing it siphon off and we were like, okay, it's time to get out, that one stung a little bit, but yeah, so it's basically like gambling, but yeah, it's a psychological. We see that. I mean, that's the thing. I would say 90% of this thing is psychological.
Mm-hmm.
So it would just be an action of the masses. I mean, anything could. We've seen.
There you go. No, you're right. Don't overthink yourself. You're right. It's the market sentiment for that stock, right?
Yeah.
It's the market sentiment and what's going on overall, right? Is the market bullish? You can report shitty earnings and still be up 23% after earnings if the market is in a huge boom right then, because everybody's buying everything. They don't care. Or the inverse can be true, right? People hate this stock. They are so disappointed with what keeps happening. And every time earnings comes out, it's going to go down because people are going to sell out because they're frustrated and they're tired of it, right? You're exactly right. Don't overthink it here. It's the psychology of the masses. It's the fear and the greed playing out in real life, in real time. And, it's not that they reported, 14 cents earnings per share versus 32 earnings per share. They could still report that and the price skyrockets. It's more about the investor psychology, like exactly what you're saying, and the way that people feel. It's the feelings on that stock, right? Do they feel greedy or do they feel fearful? And so that's going to drive it. So you're there. You're right there. Right. Don't talk yourself out of it, my dude.
No. Well, I know I work on my psychology with like the trend. I'm looking at so that's why I don't look at the news And then they have the psychology for here's my trade. Here's Mikey doing what he's going to do. How do I feel about these things? How's it lining up with the plan and that? But yeah.
Here's Mikey making markets over there, right?
Mikey's making markets, man.
Right. I don't know why you guys decided to do musical chairs while Mike was talking, but I noticed, okay, I have eyes in the back of my head when I'm up at the whiteboard. Okay. I noticed Joe. Yeah. I noticed you, bro, cutting the line, which means it's on you, my friend. No, Joe, you're next. You're next. I was going to save the hardest one for Dave, but now you're going to get it. Now you're going to get it.
Hey, I'll just say that this wasn't my choice.
All right, Joe. Well, this is your question, even though it's not your choice. Why is knowing your worst case scenario more important than trying to predict your best case outcome?
It piggybacks on what I believe it was Brad had mentioned, that we don't know the outcome of the trade. We just know something told us to go into it, the 9+ channels, or whatever the trading plan says, and something is going to tell us to go out of it. So something's going to tell us, all right, it's time to get out of this. You have made the profit you're going to make, or you did not get the horse out of the gate like you thought it was going to get out of the gate. And so we plan for a particular amount of risk. We don't plan for a particular amount of profit. We don't know what the profit could be. We don't set a profit target. We just follow our plan. So we are, in effect, planning for the worst case. We say, I'm willing for the worst case to be whatever the particular risk I'm willing to take, and position size accordingly.
Right. Now, let's say you've got your data, right? You in your real trades or in your back tested trades, and you run it through a Monte Carlo simulator, and you've got your best case, your base case, base case. I don't know why I can't say that. Base case, and then your worst case outcome. Why do we care about the worst case outcome in this situation here?
In the Monte Carlo simulator, giving us a worst case that is positive tells us that the plan is most likely to be successful as we have it laid out. And if major conditions don't change, we follow that plan, we'll be successful with the plan as it sits. So the Monte Carlo simulator is basically telling us, look, based on your history, your success, your win, your loss, the amount of wins, the amount of losses, all those factored in, which are based on your plan, those are going to lead to a worst case scenario, which in our case is positive. If it's not positive, we're going to change our plan. And it's telling us if we should continue on the plan as it is written today.
Right. Because think about it from a pragmatic sense, right? Like, Joe, let's say you're driving to let's say you're driving from Dallas to Disney World, okay? Best case outcome, you get there in 17 hours. Clearly, you're not driving a Tesla like I was. Let's say you get there in 17 hours in your best case. Average case is you get there in 19 hours. Worst case, which is what I did, I had to drive my car to Disney World. I wanted to do a big Tesla road trip one time just to say I did it. Now that I did it, I never want to do it again. Worst case, 22 hours straight through the night without stopping.
Mm-hmm. But you still made it.
Places. Why would you want to know what the worst case outcome is?
Well, first off, you want to make sure you're going to make it.
Boom! There you go. That no matter what, you're still going to get there. No matter what, you're still going to be wildly profitable. Exactly. Mm-hmm. Keep going.
If I find out that it's probably going to take me 60 years to reach my goal, I probably need to make some adjustments on my plan through, realizations of back testing, or maybe I just do not belong in this particular trading methodology, and I need to change what I'm doing in some fashion to get to my goal in the time I want to get there, or, to have a high likelihood of getting to my goal in the time frame I need to get to.
Dude, I'm telling you, that is one of my most confidence building activities that I do, is taking my numbers, throwing them in a Monte Carlo simulator, and seeing my worst case outcome is that I'm going to be wildly profitable. Bro, yes, I will continue to do my favorite job, the best game in the world, day after day after day, if my worst case outcome is that I make wildly tons of money this year. That's why we do that, right? To prove with math that even if everything goes sideways, that you're still going to come out, you know, well ahead from where you would be today. So much confidence there.
And that simulator is also showing us that there is a likelihood that you're going to have losing trades in succession. So you need to be able to emotionally gather yourself when you're going to have 7 trades in a row that are going to go bad. It's you know what's going to happen. You just have to be ready for it. You have to be able to deal with it. And the simulator is telling you, look, prepare yourself. It's going to happen. But even though that's going to happen, you're still going to be wildly successful. You're going to make it to Disney World.
There you go. Perfect. You get a score of an A on that one, Joe.
That's A+. Come on, boys.
Hey, you guys are killing it. You guys are I mean, everybody's got an A so far, but we got 2 guys left. I know one guy, if I don't give him an A, he's going to punch my teeth out. So I'm going to make sure that I give him a question that I know he's going to ace. Are you ready, JC? Are you muted? You're not quite ready. There we go.
All right, cool.
Yep, you're good now. You ready?
Yes, sir. Yes,
you're
sir.
going to love this question, by the way, JC. You are.
By the way, with my boss, you'll stop me here because I've been able to answer every single one of them. Now,
let's go.
Pitch the one that I'm going to go, Dave.
No.
Go, Dave.
Dude, look at you. Look at you. All right. Now, I remember when JC sent me an email saying he didn't know enough about trading to even spell the word stock, right? And now look at him. Now look at him. You ready, JC? Here's your final question for the day.
All right.
What is the psychology behind the sit and cash and don't F up rule? And why is doing nothing often harder than trading?
Oh, that's easy, man. Sit in cash and don't mess up. Well, everybody that's in this doing the traditional way is almost like addicted. They're addicted to trading. If they're not trading, you're missing out. If my buddy's trading and he got a 10% gain in 2 days, I'm missing out on something. And they'll gamble. And I've been doing a little bit of studying on some of the things that are that have the market going against them, but have everything else going against them, the probability of winning and all that. And if, for example, if the stock looks good and they buy cheap stuff, that's another thing. They buy, I've only got $300, exposed, but I can make, if it goes, I can make $1,000, and it's always, then I'm down 1,000. It's like, I can, if I go 500 on this one, I can make 300. I mean, I can make 3,000. So they're catching up. So all of that seems to be the way things are, and people who are in this field are kind of gamblers, and they get fidgety, and they have to do something. And since we are looking at the outlier 9, which points the rocket upward and gives you an extremely strong probability of predicting direction, not outcome, direction, then our probability goes way up higher of getting a successful trade. If that doesn't pan out, okay, put your money in a vehicle that earns you 4.5, whether it's the SGov or if you're in Fidelity, the SPAX does it for you, and it earns you a daily, and sit down and go fishing, go study. I took the time to do what you guys would call back testing. I'm just fidgeting and playing around with statistics. I'm going, what if I go this? And what if I choose that one? What if I get the spread longer? Does that do anything to the probability? And trying to get a feel for looking at the options chain, move up and down really quick, be able to calculate extrinsic value if I have to. I've got all my little formulas and cheat sheet. So learning how to use the cheat sheet to get moving quick. And I can sit in cash and not mess up and wait for the uptrend, and know that, look, I might hit three options that lose, but we have, like you previously asked, we have our way of preventing big losses. Why? Because we have to dictate where we're out before we ever come in, whether it's the half ATR or your trailing stop loss. And one of the questions is, how would you know if you logged it? How would you know? Well, first of all, did you bail out at half ATR?
Mm-hmm.
Or did you let it go a little bit fast and then you were down $50? Like, wait a minute, I'll let it go to the end of the day and I'll let it go to tomorrow. Did that happen? And if you don't document it, which, by the way, I haven't documented, and Dave and I are going through to see, is there going to be a brokerage firm ever that's going to be able to dictate everything you do with them, which would be easy, and put it automatically in their own format, in their own Excel, to be able to run analytics? What was my when I did go out early, where was it? Was it at half ATR, past an ATR? Where was it? So then you can really back test. Otherwise, you have to do it manually. And the only way you're going to do it manually is you're going to have to put all that stuff in. So to get to your answer in a long way, you have to have the discipline, man. If the rocket is not pointing outward, don't get in it. Well, what can I do? Well, go fishing, go touch grass, study, get better at this. These gentlemen are so good that, and even because they're good, they study a lot. Mm-hmm. And it always ends up that the kid doing the homework is the one kid that doesn't have to do the homework, right? He's the nerd that does it, So study, get better, whatever it is. Read a book, go and paper trade. Me, I can't do enough. I can't do it now. And I'm on a swing where an hour a day before, with my coffee, I have to either look at a video, and I've been stuck on one video where you go through the outliers one by one, and I go back, play it one by one, put it on my cheat sheet. And now I think I'm starting to get a hold of this. And now I look at an options chart and I don't freak out. I know where everything is and I can figure it out. So what is the psychology? The psychology is discipline. If it's not set up for you, put it in cash and chill. And know that you may have to chill a week, a month, 2 months. Don't get into this shit with following your friends and follow trading, because that's how you're going to lose $5,000 with 15 calls going wrong. And by the way, how can a stock go up with the bad news? I already lived that shit. I already lived that. The Palantir call came beautiful, and the thing tanked right after that. And I had set up where I go, these calls are going to blow up because I know the call's going to be good because I did the PE. I read all the shit Jeremy told me to read like a nerd, and I knew that thing was going to hit perfect. I knew the call was going to come in. It came in and everything tanked and I lost $5,000. So no, we're sitting in friggin' cash and not effing up.
But JC, when you're a trader, you got to be trading all the time, right? If you aren't trading all the time, you can't call yourself a trader. No, you call yourself a trader when you trade and win, not when you trade. Trading and losing ain't no trader. That's an idiot. I like that. That's actually great. We're all going to lose. But it's like taking a jab. No, I'm taking a jab. It's a calculated jab I'm taking. I'm just not letting you hit my face for free. Mm-hmm. I'm timing you. And as soon as that one comes in slow, you're going to understand why you should have never jabbed me. Well, it's the same thing. But JC, I find it so difficult to sit in cash and not F up. When I have all this cash that I got to do something with, what am I supposed to do? Club, bro. You're going to get more out of it that way. Wait, I'm sorry. I didn't hear you. You got to get more out of it what way? Go to a stripper club. It'll be a lot more fun and you'll get more out of it for less money. No, I'm only kidding. I don't do that anymore. No, man, you have to be disciplined. You can't say, but Chris, I got to make weight tomorrow, but God, the cake tastes so good. And I need nourishment, right? I need calories, right? No, bro, this ain't the time to eat it. This ain't the time to eat cake. We're making weight tomorrow. Sit. I love it. JC, I always appreciate how you can use your coaching skills and bring those to Outlier University. Outstanding. Because I'm afraid of JC gets an A+. There we go. There we go. Very good. All right, Dave, you are our final one of the day. Are you ready?
Fire away.
Now Dave's a smart cat, so I'm not stressed about him, but this is a difficult one. How does implied volatility affect the premium of a contract, and why is that a major risk during earnings season? I told you I'd give you a hard one.
Yep, that's an easy one for me. Implied volatility goes up as you get closer to, I'm going to dumb it down, but goes up as we get closer to earnings because of the anticipation of a large movement in that particular equity's price, the underlying price. The danger is the implied volatility crush that you're going to see. So if you look at Palantir as a great example today, go look at because I think their earnings is Friday, if I'm not mistaken. Go look at their implied volatility at what it is the day after by like noon. Give it a while and see how much that implied volatility goes down. Well, that's going to affect the option premium. That is also going to drop a bunch. So even if it were equal apples, that option value is going to come down a bunch. So if the price of the equity didn't change, the option price is going to change. It is going to go down from the crush that's going to happen.
All right, so let's start at the top of this question. What in the wide world of sports is implied volatility?
Implied volatility, as I can best put it, would be the volatility in the market with the anticipated movement in the underlying equity reflected into the option pricing. So it's an anticipated move. It's not an actual move. It's anticipating something that's going to happen, a market maker move level. Exactly. Yes. And those type of things are elevated when what happens? Earnings, major announcements happen, mergers, things like that. All of a sudden, the excitement is going to start driving that volatility level up. Mm-hmm. If there's major movements in the whole market, you're going to see some adjustments there as well, but not as much as it's when it's just magnified in that individual stock. And let's say that I, being unsure. In fact, this is a great tie-in here. This really happened in real life. Mahesh called me before earnings on this date right here. Mm-hmm. And he said, Chris, was it this date? Hang on. Or was it this date? I think it was this date here, November. Yeah, it's got to be November. He said, Chris, I don't know which direction it's going to go, but I know it's going to go big. So I'm going to buy puts and I'm going to buy calls. If Mahesh had done it at that time, which I told him not to, and thankfully he didn't, what would have happened to his trade? They both would have gone down because the unexpected is now the known. So we would have seen the volatility on the puts and the calls both go down. The calls, of course, are going to lose value because of the direction it went, or actually they're going to gain value because of the direction it went, but not at an equal to equal rate. The calls, they're going to come slamming down because the implied volatility is going to take them down, as well as the price movement is going to take it down. So the calls become almost probably worthless immediately, depending on what strike you're at. But you're going to see a lot go away, and then you're going to see the puts, even though they're gaining in value because of the equity moving, that implied volatility, it's now known. They got a problem. There's nothing unexpected now. It's already going in that direction. The volatility is going to go down, and the volume or the value of that option is also going to go down. So it could be flat. You may not be able to make anything on the put, even though you had a $10 movement. It just depends. Okay, Dave, let's say that the election's coming up and you were a genius and you heard that Hillary was coming back. She's going to take out Trump. Somehow Trump gets the ability to run for a third time, and you decide that you're going to get fancy and you buy your entire portfolio worth of call ratio back spreads. Heard this is exactly what happened to Chris in 2016. Yep. And I mean, exactly what happened to Chris in 2016. And the night of the election, you hear the market is lock limit down, and you're like going to bed happy because you're like, well, I would have made a ton, but Donald Trump's going to win, so I'm going to win some, and that's fine. And then the next day, you wake up and you see the market's up. Mm-hmm. But these calls expire on Friday, and the election was on Tuesday. Yep. How do you think that went? Pretty poorly. Pretty damn poorly.
But Dave, the market was up. Why did that make tons and tons of money?
Right, because all the implied volatility dropped. Everybody knew Donald Trump won. There was nothing unexpected anymore. You weren't buying that optimism anymore. It was already known. You know,
exactly.
I did, and I think I included it in the Discord. I did a quick Chat GPT analysis about earnings because I was curious. And what it said was that 55% of stocks going into earnings, just the stock, not the options, go down. They lose value because they don't meet expectations, or they don't meet the guidance, they don't meet the earnings per share, they go down. And the movement down is more aggressive than the 45% with the movement up. So even if you look apples to apples to say, I'm going to go bet on 100 different companies, the odds are still against you. The losers will be bigger than the winners. And I thought that was great. It's another reaffirming, quick study that said, don't trade earnings.
Yeah.
Get out of it. Just don't. I'll tell you a little fun backstory just because I was curious about it. So I have traded over the last week with single shares because I'm testing some automated theories. Okay. And I was in HIMS intentionally. I had it auto trigger a buy based on some calculations and studies it was running. And I was anticipating at some point it would curve over and exit on me. Mm-hmm. And of course it absolutely did. It absolutely worked. Now I'll tell you, I was really upset because I lost $2 this morning with HIMS. But when you look at that earnings this morning, man, if you had been in there on a call option thinking HIMS is going to go, to the moon on this. I mean, that was, I think it was like a $10 move yesterday in a stock that was trading at $60. It was a huge movement, absolutely huge. And, the IV crush on this would have been horrible and you wouldn't have survived. It was an after hours. Of course, all of them are, but after hours at the end of the day, earnings before the market opened, we went from, what do we do? Roughly $64 to $55.
Oh, it went like this morning. It went, so it opened way down. In fact, I should probably do it like this. It opened way down.
Yep.
And then at one point it was actually up on the day and now it's back nearly to where it started.
Yeah.
Dave, looking at this, what would you say about buyers and sellers on that candle?
Massive selling pressure. Massive. All day long. I didn't pay a whole lot of attention to it all day, but I mean, that candle right there tells me massive selling pressure with no support underneath it. Zero.
Yeah. I mean, not only the fact that order block wasn't there until today.
Yep.
But I mean, that's a perfect example of why order blocks matter. When these people, right, when it opened way down, that order block painted on the chart today, opened way down, and the price came up into here, those people couldn't wait to sell their shares. They were fighting to sell it as fast as possible, which is what caused exactly that to go right back down. This is why order blocks matter. This is exactly where people are wanting to get out because they are holding the bag and they are ready to get out as fast as possible. Yeah. And this is a perfect representation of what it looks like on a single day.
And Chris, look at the candle. You've got the big green candle right at the beginning of that order block, and look at the one right next to it. Yeah. Well, no, the order block we're under right now. You've got that, and that's the same deal. But if you scroll back, I believe that's a whole bunch of captured buyers from much further back.
Oh, yeah.
There's your captured buyers from all the way back in whenever that was. They were exiting out. And that was actually what I was anticipating with my study and my test. I was hoping we would catch in and catch them and, it would work. And I was testing automatic exits based on a MACD crossover in Schwab, in Thinkorswim. So kind of an interesting strategy for exits. But it worked. It worked. I lost $2.
That's a really good question here. So if you're holding and an order block appears, like today, it got painted on the chart right here, because they do take a few days to develop. It's not instant. If you're holding and an order block appears right in front of you, I assume that's the same as a sell signal?
For me, yeah.
Oh yeah.
Absolutely. Absolutely. You know, when an order block shows up, it's time to get out. And some of us use, you know, these order blocks. Some of us use Bookmap. But yeah, when you start getting really heavy order blocks, it's people trapped. I mean, they're gonna flee as fast as they can from those positions.
Exactly. No, that was a perfect example. Dave, you perfectly answered that question. Joe, however, is trying to sabotage your grade. Joe?
Yeah, I've got a
Here's
question.
what it is.
I believe that after listening to Dave, implied volatility has a price, a dollar value, right? That dollar value is always contained in the extrinsic part of the calculation, right?
Yes. The implied volatility cannot be intrinsic. It must absolutely cannot be an intrinsic. It has to be located in the only other place, which is extrinsic.
So the fact that we do not go larger than a 20% extrinsic means I'm already taking into account both time and implied volatility. So I'm kind of protecting myself against implied volatility being high.
Yes, exactly. And that's why when implied volatility is elevated, I don't even notice because I just go further up the options chain, right? My goalpost is 20%. If it's less than that, great, I'll take it. But I will absolutely under no conditions take 30% or greater. So 29% is my hard limit, but generally it's around 20%. So yeah, and it gets completely negated when you just go up the options chain further up the strikes.
Yeah. Okay, cool. Yeah, that explains why when you go up the chain, sometimes you'll see a big change in the extrinsic value because you're probably facing earnings that month, or that expiration date is probably really close to earnings.
All right, Dave. Even though Joe tried to sabotage you, still gonna give you an A. I'm still gonna give you an A. I thought about just being a jerk and calling it a B+, but no, you definitely earned that A, my friend.
I'm well past grades at this point. I'm about
outstanding
money.
Outstanding work to you, Dave, and outstanding work to all the gentlemen here in class. We will be doing this again on Thursday, and the questions, if they're hard now, just wait. I'm gonna tell ChatGPT to ramp them up even harder. It's way easier than me doing it myself. And then we will make sure that your final day of Outlier University is the hardest class that you're ever going to take. How's that sound?
All right,
guys. Outstanding work today. You got 1 day to prep for the next class, and I'm really proud of you. I mean, think of where you are today versus where you were just a few short weeks ago. You have absolutely killed it. Right. And some of you
I'm gonna ask Scott to hack Outlier so we can get the answer to the questions.
There is some big stuff going on with Scott. I can't talk about unless Mahesh has already mentioned it in the Discord. Hold tight. Let me pop in the Discord for just a moment. I want to see if he's mentioned it. I'm not letting the cat out of the bag, but you're probably going to see a lot more of Scott. I'll put it that way.
Good.
So you guys are killing it.
He's a good guy.
And I will see you back here on Thursday. All right, gentlemen. Talk soon.